I would like to, before start, point your attention to two things that you've already heard. One of them is where will production increase come from, that Victor mentioned, and the other one is how is the macroeconomic outlook looking like for the rest of this year. And we'll be covering this a little bit in more detail throughout the product presentation. In terms of total product demand, we anticipate around 1.3 million barrels per day of year-on-year increase this year, mainly on the heels of transportation fuels. Especially strong we expect to be jet demand this year. Now there are a couple of nuances to this story. A, it's not going to be a story of equal distribution between east and west of Suez, because as Alex pointed out, the west of Suez headwinds, economic headwinds, are painting an increasingly disappointing picture for total product demand, especially in Europe and in the US. On the other hand, India is covering one height after another. Indian demand is standing strong. Indian demand is probably going to remain strong this year in our expectations, together with China. Now, China is a bit of a mixed bag in terms of domestic demand. So far, we've seen demand doing relatively fine, but nothing spectacular, as Alex pointed out. Add to that the fact that actually Chinese economic performance this year is expected to be back on track of healthy performance, but nothing out of the usual and nothing back to pre-COVID levels. And we come to this relatively subdued outlook for total product demand. In addition to that, I would also like to point your attention to the other fact, which is if a big chunk of the demand increase is going to come from some revenge demand recovery on the heels of jet demand this year, this is also the product that historically, ever since the beginning of the COVID era, so to say, has been the product most exposed to abrupt changes because of movement limitations. So bear in mind this, and as we move further into this year, jet is going to start playing an increasingly bigger role into total product demand. Now, where does this leave us in terms of refining? There are a couple of things that are worth highlighting. First and foremost, after the recent wave of consolidation pressure, we have a little bit of a shift in the global refining landscape right now. So the center of refining is much more pronounced to be in the east of Suez rather than the west of Suez. And particularly interesting in that regard would be the buildup in the Middle East. Middle East is adding considerable capacity this year, and we expect that this is going to be an increasingly bigger topic going forwards. Now remember this point because it's going to get more relevant in a bit. The other side is who is going to be cutting runs and who is going to be feeling some consolidation pressure. In that regard, Russia comes to mind as a prime example, as we are already seeing that Russia in its own right is having problems into placing all its barrels into international markets. Take, for example, naphtha. Some VGO is already left to the market, and we are already seeing in February export numbers that total Russian product exports are struggling. So this is one of the places where we expect essentially lower crude intake figure this year to be painting an increasingly convincing picture of consolidation pressure. The other key place we identify is OECD Asia, and in particular Japan. A, because domestic demand in Japan has never really returned to pre-COVID levels, and B, because OECD Asia is one of the most exposed regions in terms of access to feedstock. And the third point I would like to highlight to you is China. Now, whilst we've been seeing massive capacity increases in China, it's also worth highlighting that these net capacity increases are actually masking capacity closures on the side of independents. In fact, between 2018 and 2022, we identified north of 500 KBD of capacity closures that have already occurred on the side of independents. And by the end of next year, we identify already additional 200 KBD of primary capacity already slated for closures. Add to that the fact that the limitations to import quotas and to product export quotas are still in place, very much in place, as we've been seeing with the fact that the Chinese independents have been going for Russian HSSR. This paints an increasingly difficult picture for the Chinese independent players. One of the other reasons for that is that because of the high capacity buildup in China, on the side of NOCs, the independents will be feeling the heat into retaining crude runs and utilization rates going forwards. But generally speaking, By the end of this year, we'll be adding sizable capacity compared to pre-COVID levels, whereas demand is not there yet. So someone will have to reduce runs, someone will have to reduce utilization rates further down the line. And in this someone, we identified China as one of the big places that will be increasing runs on a year-on-year level. One of the reasons is the low baseline from last year. The other reason is, of course, the recovery in demand in China that we are seeing, and the new capacity additions making good on these. The new capacity is making good on their investments. Another place is the Middle East, and here it's worth highlighting one aspect of the market. It's that with the massive capacity buildup in the Middle East, we are actually seeing sizable capacity of medium crude that will be taken out of the market. And medium crude is exactly what the market needs right now, given the structural tightness that we're seeing on the side of middle distillates, especially in Europe. So essentially, whilst we are adding new capacity, the regions that are most highly reliant on import feedstocks will be struggling into finding sufficient feedstock for their refineries at the time when domestic demand in some places is predicating that utilization rates will be struggling. Because, of course, if domestic demand is not struggling, you are essentially left to the mercy of export markets. And if export markets are being dominated by other players, as is the case in East Asia, for example, then you have no other choice but to try and reduce runs. In that regard, we identified Japan as one of the key places where utilization rates will probably start suffering towards the end of this year, as the new Chinese capacity is starting to make good on regional export markets, given the fact that Japanese demand, as I already mentioned, has not really recovered to pre-COVID levels. Another place that could potentially be facing some headwinds is Europe, but we'll get to that in a second. And the reason for that is the rising complexity of the global refinery system. As you can see on the chart, with the essentially indicating the size of the refinery system compared to the global system, and where does it stand in terms of feedstock import requirements. Europe and the US have essentially, Europe, China, and US have very complex systems, meaning high conversion to CDU ratios. For these systems to work properly, you need heavier or at least medium crude. Now, Europe is already deprived of its feedstock of the swing Russian barrels. The Middle East is taking out, as I've already mentioned, a lot of medium crude out of the market. And on top of that, essentially, where could this additional supply come from? Right, so we actually anticipate that there will be some problems into trying to secure sufficient feedstock for the European system, as Europe remains structurally tight in terms of middle distillates. Another place is like, okay, but how about if we see higher runs in China and India? Well, yes, of course, and this is also another problem that the Russian refinery system will be having later on, is that higher utilization rate of primary units, basis discounted euro supply, will essentially predicate you not to be importing sizable amounts of secondary feedstock, which will be one of the problems that the refinery system will be having in terms of retaining refinery runs. While speaking about secondary feedstock supply, essentially the Atlantic basin is no longer having any access to the Russian VGO exports. Of course, there has been some substitution with other feedstocks, but essentially once the secondary units of all the more complex setups in the Middle East start making good on the investments, this supply is also going to start suffering. So in that sense, next best thing that you can do is try and turn to the bottom of the barrel and try and find some support in there in terms of securing feedstock, which predicates on structural support. And as you can see on the chart on the right-hand side, all the sizable chart, the bigger part of the capacity shut-ins that we've been seeing over the past couple of years have been on the side of less complex setups, meaning lower conversion to CDO ratios. All the while, we are adding more and more complex setups that are essentially predicated to be running on medium and heavy crude supply. So if you want to get something out of this chart, is that expect that there will be some tailwind for the bottom of the barrel, and expect that those refiners who don't have easy access to suitable feedstock will be exposed to consolidation pressure, especially in Europe, in the US to a lesser degree, because because of, the US is less dependent on imports compared to Europe, and also the US system is more complex, i.e. it has higher flexibility in that regard. Now, speaking about changes in crude diets, we've already identified a couple of key points that I would like to point your attention to. One of them is the change in NWE's crude diets. Over the last couple of months, essentially ever since China has come back to the market, we've been seeing a gradual lightening of the crude slate. As Victor pointed out, it's becoming an increasingly visible problem for the European refinery system, because at a time when you need heavier crude, you're essentially running on a lighter crude diet. What this means is that the gasoline balance is going, or the light distillate balance in general, is going to continue lengthening, which is not what you want. You need to fill the gap of the loss of the Russian barrels. So this by itself is another factor that is already giving us a taste of what is to come. On top of that, again, like the lack of secondary feedstock supply from Russia, and the lack of high sulfur straight run supply, or like the reduced availability of high sulfur straight run supply, because the Russian system is out of the European trading system now, is again predicating some support for the bottom of the barrel going forwards. And of course, going to the elephant in the room, how is the European gas oil problem looking like right now? Well, a little bit better than probably initially expected. European inventories are building. We know this from our independent inventory levels. They're already nearing 5-year average. They're already at within the 5-year range level. So depressed demand, as we've already seen in EU5 January readings, coupled with increased buying prior to the launch of the EU ban on Russian product imports, has helped inventories build somewhat, which is providing a cushion for short-term shocks. Now, a couple of things in that regard come to mind is that, of course, we are now entering maintenance, or we are already within maintenance season in the European refinery system. So this is definitely not going to help. Depending on the demand situation, which we don't expect to be fantastic, things are starting to look a little bit less long than they've been over the last couple of weeks. So expect some recovery here as well, although the fact that the economic headwinds will be starting to be felt a little bit more seriously than before is also predicating that things are probably not going to go into the levels that we saw last summer. And speaking of the levels of what we saw last summer and how things are changing, we've run a bit of a thought experiment within the team of trying to find the technical solution to the European shortfall of supply of gas oil. And in terms of what the flexibility of the system can offer in order for Europe and the US in general to solve part of this problem, we identified around 450 kbd of additional supply between May and September that can come from both systems. 250 in Europe and 200 in the US. It could potentially help alleviate some of the pain in middle distillate markets. The other solution, of course, will be the looming launch of the second units of Azur, where we identify around 180 kbd of additional USD supply. And of course, the close to 500 kbd of Chinese capacity buildup that we've seen launching the market already over the past couple of months. On top of that, there is the speculative element of when will the secondary units of Jizan start running as designed or as expected. And as we don't expect this to be happening before the end of H1, we would for now rule it out as another factor in middle distillate markets. But I would like to also mention one thing to this chart. It's the fact that it's probably not going to be all of these things happening at the same time, i.e. if the Middle Eastern supply is struggling, or if Chinese demand surprises to the upside and a lot of material remains at home, then the European and US systems will be able to pivot this into higher supply, and vice versa. Higher supply from these places is going to disincentivize higher runs and higher production of middle distillates. So it's not like we could potentially add 1 million barrels per day of additional USD. It's more like some of the solution will be coming from one place, others from another. And for the time being, it seems like the east of Suez is a little bit better positioned into filling this gap for Europe. And Moving on to gasoline markets a little bit, the high runs in Europe and the lengthening crude slate have led to a strong lengthening of the European gasoline balance, as evidenced by the rising inventories and as evidenced by essentially European mogas diesel spreads failing to catch up with the rest of the major regions, especially in Northwest Europe, I mean, of course. All the while, US inventories are continuing to struggle. They're well below 5-year, not well below, but they are below 5-year range levels, and we are only now starting to feel the full effect of US maintenance season on product supply markets. What this suggests is that the transatlantic ARB window is probably going to start opening a little bit sooner than normal. It will be slightly better than historical levels. And the key takeaway, in my opinion, from that is with the US gasoline exports struggling because the balance is tighter than normal levels, this opens up an opportunity for European refiners to export a little bit more of their lengthening gasoline availability to places where US is currently working on, being Latin America or Africa. And on that note, I would like to summarize things for you a little bit so that you go away from this room with a little bit of key points to bring home. One is that indeed demand is improving, but we are not seeing it at levels that would predicate massive improvement from where they stood last year. The major reason for that are the economic headwinds, and China's reopening is not going in the direction as initially anticipated, that it's going to make a full recovery. We're continuing to see some headwinds there as well. India is going to be one of the strong points in product markets this year. Another key takeaway is that the global refinery system is shifting. It's changing, and it's been changing for a while. One of the things that will be defining markets going forward will be the rising complexity. So as Victor pointed out, the biggest supply that we see this year is going to be coming from the US, which is, of course, providing not the crude that the market requires for the most part. It's light in general. So on top of that, we're taking away a sizable chunk of the medium crude that is being currently exported out of the Middle East. And so this suggests that the rising complexity will be setting up the stage for rebound in the middle of the barrel. On the other hand, yeah, exactly. Europe's diesel problem, on the other hand, has so far been reasonably well handled, but sustainable solution is still out of sight. The changes in Northwest Europeans' crude diet are already giving us a taste of what is to come. Lighter crude diets for some players predicate that light distillates will be lengthening, suggesting further headwinds down the line, but also suggesting that they won't be incentivized to run as high because they essentially won't be having access to suitable feedstock for their systems. And on the other hand, though, it might not be the worst timing ever, because with US gasoline balances tighter than usual, inventories depressed, gasoline's time to shine is also coming quick. Will it be as strong as last summer? Probably not. Will it be better than the recent levels? Most probably, yes. And on that note, I thank you very much and open the stage for Q&A session.